pattern featured in this tutorial is responsible for reversing the worst stock market crash of our generation. In 2007-2008, the stock market experienced a horrendous crash. This pattern then formed all over world indice charts and has pushed the stock market up to all-time highs at the time of this video being filmed in 2013. What we need to discuss with you first is different characteristics you will find at a stock market top and a stock market bottom. What we mean by that is if you buy shares and the price goes upwards and then you spot a reversal pattern on their share chart, that can be called a top. What you'll find at the top is reversal patterns in general take a lot less time to form. The price swings within that pattern are a lot more volatile than at a bottom, and when you come out of the pattern, the market will fall a lot quicker than it will rise. At a stock market bottom, the reversal patterns normally take more time to form and the market will rise slower than it fell. And the reason for that is because you need buying activity to push shares upwards, whereas you don't necessarily need a domination of sellers for a market to fall, you just need lack of buyers. What we'd like to show you now is what factors influence the importance of a reversal pattern.
So we have two examples of the inverted head and shoulders. We have a large and a small example. There's a left shoulder, a head and a right shoulder, forming the larger pattern inverted head and shoulders, and the smaller pattern left shoulder, head and right shoulder. What you need to look for is the height of the pattern. You see how the bigger pattern is much deeper than the smaller. The price swings will be much more volatile in this pattern rather than the relatively flat pattern at the bottom. The next is the amount of time the pattern takes to form. On the large pattern is much more candles than on the smaller pattern, making the larger pattern the most important pattern.
So, the two main factors that influence how important a pattern is on a stock market chart are its height and its width. The height measures the volatility, so the more wild the swings, arguably the more people trade in it. A lot of people have a vested interest in that share, so it does become quite important when you see that pattern. The longer it takes to form, arguably the bigger it is, so it's more important because it's more obvious to other traders. If you spot a small head and shoulders, it won't have the same effect as a large one on a stock market chart. What you can also get is small patterns within a reversal pattern, and these can give us other clues that you are right about the stock market being at a top or a bottom. And before we show you what we mean by this, what we want to quickly tell you is it's not just reversal patterns this works for, this also works for continuation patterns. So if you spot quite a wide and long continuation pattern, it's much more important than a small one.
So we have a large inverted head and shoulders. We have the left shoulder, the head and a right shoulder. Pretty much an upside down head and shoulders like we showed you before. The market puts in a higher low, which is the first sign, just like previously discussed. With the head, the market puts in a low. It drops very quickly and then bounces all of a sudden, almost like a spike bottom. That is another reversal pattern. So the price rebounds very quickly and then it puts in a higher low. That is the point in which the market has reversed. Here is also a continuation pattern, as you will learn in the next series. So you've got the inverted head and shoulders, a spike bottom and a continuation pattern in the right shoulder.
Before we send you on your way to the continuation pattern series, we have another tip or two just quickly for you guys. We find it easy when you look at a stock market chart to spot an upright head and shoulders. So what we sometimes do, if we're not quite sure if we're looking at an inverted head and shoulders, we look at the computer screen upside down because it's a lot more easier to identify because it looks like an upright head and shoulders but just a mirror image of it. Also, pay particular attention to the right shoulder on an inverted head and shoulders. The lower the shoulder, the earlier the buy signal. If you get one a little bit higher, you have to wait a little bit more for that buy signal. We have an extensive lesson on this on our eDVD because it's quite a complicated subject that you must get right if you're looking to trade. Just to quickly conclude then, reversal patterns must have a trend to reverse. The bigger the pattern, the more important it is and the more powerful the reversal will be. Also, the retracements that we showed you in the ebook are brilliant ways of taking profit or entering. What we want to now do is introduce the next tutorials, which will be the first of the continuation patterns. Thank you for your time.